and I'll just kickstart my presentation. And first of all, thank you, Ethan, for the wonderful introduction. And of course, thank you all of you for taking the time off to attend today's webinar. So if you look at markets over the past few weeks, I know we are coming off a very low volume year-end festive season. If you all realize the Santa Claus rally did not actually pay out. So we know that it will continue to be a very, very unprecedented year where markets will continue to struggle with where inflation will go, where growth will go, and ultimately it will determine where the peak Fed's rate hike will be. So with that, I'll move on to several themes that you can actually watch into 2023. First of all, just to reiterate again, any material shown here is purely for educational purposes only. It is purely my own views. So hopefully it can help to value add in terms of your own investment and trading views. So by no means it is a buy or sell call. So just take note of that. I will not introduce myself again, but just two things here. Namely, one will be my Twitter handle at @it_IG. So if you have a Twitter account and you want some free market update, do feel free to follow this Twitter handle. Otherwise, I know that Telegram is the in thing now for trading ideas, right? So we have this channel called IG Asia. So every day we will have a team of analysts who will provide some form of investment view or trading views for you. So if you have a Telegram, do feel free to look for this group called IG Asia, and just feel free to join. Okay, so I think the whole presentation today is sum up. The key points is largely a sum up in these slides. So if you need to drop off early, no problem. You can always revisit these slides, or you can tune in to our recording that will be provided at a later date. But these are the general themes that personally I am looking at for the whole of 2023. So later I'll dive deeper into each point, but just to just briefly touch on it. One is that I believe that the peak may likely has been in for the US dollar. The number two will be the Japanese yen. For those in the Forex market, I think the Japanese yen could continue to find further strength into 2023. So later I'll provide my arguments, why I think that is so. Third point, first half 2023, I think we will keep hearing more and more about recession talks being amplified over the coming months. If you look at current economic data versus market expectations, current economic data is still presenting a lot of downside surprise. So a downside surprise meaning that expectations is for an expansion, but when it come out, it actually points to a contraction like what we've seen in the latest US services PMI. So in a way, I think there is this misalignment between market expectations and also what economic data is presenting to us. In a way, in the sense that market expectations could be pricing economic conditions to be more resilient. But looking at the ongoing downside surprise in several economic data, of course, the jobs market is still very resilient. But if you look in terms of the manufacturing and services PMI, both actually underperform expectations, especially for the recent services PMI, it underperformed by quite a huge margin. So I think moving into 2023, we have to see somewhat market expectations being more aligned with actual economic data, because otherwise it just means that there is some form of underpricing of a growth risk there. And with that, they will call for a further re-rating, which means a further downside in equities. So for the first half of the year, I think things will still be very volatile. I think we haven't fully aligned yet in terms of market expectations and also the current economic data. So there will be a lot of volatility that I feel will be presented in the first half. And historically, a lot of people are looking towards rate cut to save the markets, like correct, right? The moment we see the rate cut, people are happy, markets will boom. I beg to differ on that. Yes, no doubt, whenever we see a rate cut, generally it means that the central bank is stepping in with a stimulus support. But if you look towards history, generally, when there is a rate cut, two things. Number one is that something will break in the economy to warrant this rate cut itself. And second is that whenever there's a rate cut, just based on a market psychology, a lot of buyers will jump in. So generally, there tends to be one last wave of a sell-off to sort of, you can think of it as trying to drive out all these weaker hands. Okay, and thereafter markets will start to find somewhat of a bottom. Okay, and when we were to reach into a recession, we do not know yet. Current economic data does suggest that there is some chances that we can still avoid. But in the event where we fall into a recession, two sectors that will come into play that tends to outperform as shown over past recession. One is healthcare, one is consumer staples. So I remove utility sectors from this sector play, namely because US utilities tends to underperform during past recessions. So even though it carry that status of being a defensive one, but past performance does not actually present them to be as resilient as healthcare and consumer staples. Okay, so first half, do expect further volatility. Second half, that is where we can start to look towards, the bottoming of a corporate earnings, hopefully the bottoming of a market. Things are still very data dependent, but this is my current narrative for now. Of course, it depends on how inflation and growth data will turn out over the coming months. Even the Fed members themselves say that they do not know where inflation will go. They are all staying very data dependent. So these are markets where we have to be more reactive rather than predictive, because most of the time, prediction, you realize that prediction can actually go wrong, and especially with current volatile times where the Fed is also becoming more reactive, I think we have to take on the same role. So, but hopefully second half, we can see some form of a bottoming out in the market. I think there will be talks of a rate cut. The general reason is because if you look at market pricing from the bond markets, they are expecting the Fed to pause its rate hike in March 2023. So that will be in 2 months' time. And historically, whenever there's a pause in the rate hikes, the rate hike doesn't last very long. Generally 6 to 9 months later, it will follow with a rate cut. So this is just based on some of the historical occurrences. So if you just project it on average, the last rate hike in March, we can look towards a rate cut potentially in September to December 2023. And that is where, when potentially a recession may occur, and with rate cuts talks being in play, hopefully we can see a very strong wave of a sell-off, and that will provide some opportunity for us to accumulate. Because we know that every time, generally when there's a recession, when sentiments are sour, that is actually the best time to really jump in to accumulate. So hopefully September, December, that could be the timeline where we can see the last wave of a sell-off, and that provide opportunity to load up on a long position. Okay, the fifth one is mainly on energy sector. This is just one chart which I will show you later. Generally, we know the energy sector has been the top performer in 2022. So heading into 2023, can it continue to outperform? Later, I'll just show you the relationship between the energy sector and also oil prices, because both tends to move very closely, but recently their relationship has been diverging. Okay, last but not least, reopening play. I think China equities will outperform this year, but it will not be a one-shot wonder. We know that markets won't go up, won't go up forever. There will be a form of retracement that we can look out for. Later, I'll present some of the headlines that I think could be catalyst for retracement, and but overall, the buy the dip narrative should be in place. And for those investing or trading in the Singapore market, two narratives that you can look out for. One is that I think the STI, currently the recession is not the base case. That's a very good point, but growth will remain muted. And second is that I think we can start to take a look at some of the REIT sector. Not yet, but I think the time is sort of nearing. So later I'll present on why I think so. Okay, so these are the full main theme that personally I'm looking out for 2023. Okay, moving into the first point, the US dollar. I know the whole story is about the Fed having this peak narrative, peak hawkishness, sorry. The Fed having this peak hawkishness. We are looking towards a peaking in rates. And historically, I think if you look towards a past economic downturn, it doesn't mean that the US dollar will remain strong. Okay, historically, they tends to fall at least for the initial part of the economic downturn in terms of recession, despite the currency carrying this safe haven status. So peak in US dollar, Further moderation, I believe, will bring further implications onto other markets, such as the emerging markets. Later, I'll just show you a chart on that. But for now, if you look at funds net short positioning, so you can see this red line here that divide, funds positioning between an overall net long or an overall net short. So just looking at September itself, you can see that the past build up in terms of net long position has seen some unwinding in terms of this blue line, heading below, crossing below zero, and funds are actually accumulating a net short positioning now. And if you look at data from last week, the overall net short stand at 6.8 billion. If you compare to a month ago, it's at 0.6 billion. So there is somewhat of a build up in terms of a net short positioning for the US dollar versus the other major G10 currency. So if you ask me how I look at this, of course, we want to follow the funds. The funds may not be right all the time, but I think following them do have a higher chance of success. And if they are accumulating somewhat of a net short or even building up their net short positioning in the US dollar, it does seem that the overall peak in the US dollar could be in, and any upside could provide the opportunity to sell the top. Okay, so if you look at the US dollar, I think this chart is kind of outdated. I think the latest update as of today is a break below the key consolidation support below. So the US dollar has been trading over the past few weeks in this ranging pattern. So you can just draw this rectangle. It has been ranging largely because of that, hawkish takeaway from the Fed meeting, being pitted against the year-end positive seasonality. So there is somewhat of an offsetting there. And also the year-end tends to see a quieter volume. So fair enough, that kind of forced the US dollar into a very ranging pattern over the past few weeks. But recently, I think it has broken below this 103 level, which is the lower consolidation base. So what this means is that it forms a new lower low. And with that, it generally points towards the ongoing downward trend. In terms of a formation of a lower high and lower low, that kind of points towards a downward trend for now. So bias remains to the downside from the charting pattern also. And if you look at the previous one, generally the funds could be, further accumulating further net short positioning. Okay, what implication could it bring? Generally, if you look at the US dollar versus EM assets, emerging market assets, there tends to be an inverse relationship. So this chart actually shows the inverse US dollar versus the emerging markets index. So why is this so? Of course, there are some economic theory. I think you can read it from the textbook. One is that a weaker dollar tends to help reduce this foreign exchange debt stock, and also service burden for many of these emerging economies, because they tend to carry huge debt in US dollar. So if US dollar weaken, it kind of relieves the pressure for them to sort of service this debt for the country. So the second one is, of course, if a US dollar decline, generally the emerging market currency could look more attractive in terms of relative terms, and that could help to attract more capital inflows into the country in terms of investment, in terms of property prices, asset prices, and all that. And last but not least, I think more particularly for the Asian emerging economies, if you look towards China's reopening story, generally hopefully there could be some positive knock-on impact on the regional markets as well. So we know that there has been some potential for a pent-up consumer demand from these Chinese consumers. It will not likewise be a one-shot wonder. Recovery will be gradual. But generally, I believe that with reopening, it helps to provide some form of a demand for exports that could help to cushion many of the exports-oriented economies in Asia. So this will be one of the themes that I'll be looking at. Second will be in terms of the Japanese yen. So previously, if you look at the dollar yen, it has been one of the strongest performing asset in 2022. And one of the reasons is because of the policy divergence between the US Fed and the Bank of Japan. So the Bank of Japan has been very stubbornly accommodative. So they insist on keeping their rates close to zero, even though there's some adjustment in terms of the leeway recently. But they insist of keeping it, short-term rate in negative territory, longer-term rates around zero. Whereas on the other hand, the Fed has been trying to catch up, has been trying to front load a lot of rate hikes in 2022. So this divergence in policy has been one of the key factors that has been fueling this strength in the dollar yen in 2022. But heading into 2023, I think the narrative could start to see a turn. Namely because we are looking at peak hawkishness in across many global central banks. So many central banks are starting to wind down their pace of rate hikes, their scale of a rate hike to be exact. So we have seen the RBA doing that. Recently, we have seen the Fed doing that. So the peak hawkishness is somewhat in play. But on the other hand, for the Bank of Japan, it seems to be taking on a different direction. So after keeping monetary policy so easy over the past 1 year, inflation is picking up above its 2% target, and people are looking towards potential for a rate hike in 2023. So you just look at this chart. This is from the Bank of Japan rate futures. This is what market are pricing. Generally, in January and March, the consensus is still towards a no change in a short-term rate. So currently short-term rate is at negative 0.1. So they are predicting a no change, but the stance could change in April when we will have a new Japan BOJ governor. And people are expecting that there could be a 0.1 point of a rate hike. And thereafter, the direction seems to be on further rate hikes across towards the end of the year. So I think this points towards some form of a dwindling policy divergence. So when we are talking about somewhat of a slowing in terms of the Fed and other central banks, whereas the Bank of Japan is trying to pick up the pace in terms of rate hike, it does help to drive these lower yield differentials between other major currencies versus the Japanese yen. So if we look towards the recent positioning for the Japanese yen, previously it has been in very deep net short positioning. So these are the positioning from large speculators based on the CFDC data. It doesn't provide any indication for a buy and sell, but it does provide somewhat of a clue on where sentiments are, because this data tends to be lagging. So generally it comes with a 1 week lag, but nevertheless, we can look towards where sentiments are. So previously there has been, accumulation towards the net short positioning. You can see that all the way from January 2021, everyone has been shorting the Japanese yen. So how I look at this is that recently there's some recovery, but it is still largely in a net short positioning, largely because over the next few months, the old governor is still in play. It could continue to see a further pushback that, they will try to argue that they are not trying to deliver a hawkish shift in terms of a policy. Fair enough, but ultimately, I believe that he is laying the ground for the new governor to sort of or shift his policy when he take over in April. Okay, so this is what I'm looking at. I think there are room for a further unwinding of all of these short positions, and with that, that could bring about further strength in the Japanese yen. And if you look towards other global central banks, kind of slowing down, hopefully looking at the pause in rate hikes, the yield differential story really doesn't play out as much to provide weakness in the Japanese yen. So this will be what I will be looking at for. Okay, in terms of technical analysis, Japanese yen has been trading within this descending channel pattern. So you can draw this very nice channel here. Recently, there was a retest, and then it does it failed to actually break above this channel pattern. So just following this channel does suggest that we could see a retest of the lower channel support at around the 126.8 level. But one of the key horizontal support that we have to break will of course be the 130.8. So these are two levels that I'm closely looking out for. And if you look at the dollar yen, it has actually broke below its 200-day moving average on 20 December for the first time in many years. So generally, when we look towards trends, the longer term trends, investors or traders look towards the 200-day moving average. So a break below does suggest that we could be looking at this longer term trend reversal in place, as you can see from the chart. Okay, the third point I think is all about the recession story in the US. So for now, I think one of the quick indicator that we can look towards will be the data from the Atlanta Fed. It's called the GDP now. So basically, they tends to update this data every week to kind of show you how their projection for a real GDP estimate is currently at, just based on more real-time economic data. So for many of us who are busy having to monitor so many indicators, I think this could help to provide somewhat of a quick glimpse of where economic conditions are. So looking at this data, the latest one which I just put today, generally recession is not the base case for fourth quarter yet. So the upcoming GDP data could continue to show some form of expansion, especially coming after the very robust labor market. So there was some kind of pushback against recession fears. But as we know, there is some lag time, there's some policy lag between monetary tightening towards the eventual effect on economic conditions. So generally it takes 6 to 9 months. Some may argue that it could take shorter because market expectations are already expecting the economy to sort of decline. So, but nevertheless, there is some time lag, and I think this will be something that we will be closely monitoring. But the good thing is that recession is not the base case for fourth quarter yet. Whether it will be for first quarter or second quarter potentially, coming after all of these some of these declining economic data. So do watch this space closely because when there's a recession, I think some of the value sectors could start to give way, because now if we look towards the value stocks versus growth stocks, there has still been a preference towards value, partially because investors expect them to really be the safer play when there's a recession. But generally, when we look at a recession, we are looking at a broad-based decline across all sectors. So I think that when there is a recession, I think the sell-off will be broad-based. I think the value sectors may start to cave in also. So we'll do keep a lookout on this space. Hopefully we do not have one, because it will have a knock-on impact on Singapore's economy, on our livelihood. In the event it does, do keep a lookout, because when there's panic in the market, that is the best opportunity to accumulate. Okay, so for now, recession not the base case, but what I'll be looking out for will also be corporate earnings. So I know we know that economic conditions are worsening, are deteriorating, but every time when there's a earnings season, generally it can provide somewhat of a reminder to market participants whether our economic conditions are having less bad than feared, or actually things are getting much worse than expected. So when we look at stock prices, of course it follows corporate earnings very closely. So I think moving forward, the first quarter can be a tough one to navigate through. I think that we may have to see somewhat of a bottoming out in terms of a corporate earnings for us to really have a greater confidence that the market bottom is near. So first half of the year, things are still rocky. I personally do not foresee that we could have that. Second half of the year, potentially, so we can keep a lookout. So if you look at the past global recession in 2007, 2008, corporate earnings also declined drastically. But generally, market look towards some form of a hint that corporate earnings are declining to a lesser scale. So that is where they believe that things are getting better. Then that is where the recovery is in place. They believe that the worst is over, and that kind of marks the bottoming out in terms of the equity markets. So hopefully this time around it will play out the same way. For now, we know that corporate earnings will continue to decline, but trying to find a consistent trend that things are declining to a lesser scale, I think that will be something that we can watch out for in 2023. So for the S&P 500, very interesting. This is my personal chart. I think, of course, this kind of outdated. I think recently there was sort of a break above this ranging pattern as well. But two key levels that I'm looking out for, I think we are closing into this moment of a reckoning. Why? Because one level I'm looking at is the 3,800 level. So what I'm looking at this is that, if you know what are Fibonacci levels, this kind of marks a confluence zone of two Fibonacci levels, one shorter term, one longer term. But I think recently the markets have been trying to battle it out. The bulls and the bears have been trying to battle it out at this 3,800 level. And just now it is at this Fibonacci confluence zone. So I think it does hold some level of significance to market sentiments. So on the downside, I'm looking out for 3,800 as potential support. But on the upside, we can draw this downward trend line resistance. The S&P 500 has failed to break past this trend line resistance on at least 5 occasions since 2022. So likewise, I think this trend line resistance also carry a very huge level of significance. So with this closing in, I think there will be a struggle. I think markets will eventually have to choose a direction. And that will be something that will be very interesting to look out for. Because if you look at this ranging pattern, I believe that whenever we see a range, there has been a build-up in both buyers and also sellers. So when we have this ranging pattern, whenever the market chooses a very clear direction, I think that will provide opportunities for short squeeze or some cut loss from the long buyers, depending on which direction they go. So 3,800 and also the 4,000, that will be something that I'm personally watching out for. Okay, and when we look towards a potential rate hike pause in the second half, I know for now value stocks have been gaining a lot of tractions versus growth, considering that when we look at higher interest rates, the perception is that growth tends to be more debt dependent. The valuation tends to be more dependent on the risk-free rate. Fair enough. So if you look at this chart, the ongoing preference for value versus growth, the trend has been intact. But what I'm looking out for is the second half of the year when we are talking about rate hike pause. I think that helps to provide greater clarity on in terms of how you value these growth stocks, because we know that we could be reaching this peak interest rate from the Fed. That really helps to provide a clearer picture on whether we are underpricing some of these growth counters. And I think that could also provide some opportunities to accumulate into the second half. And when we talk about an economic downturn, of course, those smaller growth-sensitive counters have a greater risk of caving in to economic pressure. But many of those big tech companies, I think they tends to be resilient in terms of their product demand. So even when we are looking at a downturn, generally, you can ask whether will firms really cut back, or really, how much can they cut back in terms of their cybersecurity spending? How much can they actually really cut back on their, cloud services spending? How much can they really cut back on some of these services, software, or even in terms of consumers hardware that we are looking at? So personally, I believe that some of these big tech actually, even though they are called, tech, and people label them in terms of being growth sensitive, fair enough. But over the past many years, many of these big tech has shown to be able to be resilient in times of economic downturn. So in a way, they take on the status more of a consumer status, because when there's an economic downturn, there's still demand from consumers and firms for their product and services. So this will be something that I'll be looking out for in terms of the second half. I think we may not be there yet. Generally, those that start to cave in will be the smaller cap. So we have seen the smaller cap caving in. If you just look at the index, those smaller growth sensitive one, they have caved in by a lot. It's still on the downside. If you look towards, but I think now is the time where we see some of the big tech starting to cave in. If you look at Tesla, I think previously it has been holding very strong, but over the past month it has started to tank. If you look at Apple, the chart, previously it has been very resilient, but recently it has started to sort of cave in also. And I think this is what we want to see, right? Because the moment they start to cave in, we believe that it could be getting nearer and nearer to where we are looking out for in terms of market bottoming. Okay, so if you look at the Nasdaq 100, likewise, I think it presents some form of a moment of a reckoning ahead. Same thing, the downward trendline resistance continues to be in play. We can see that the index actually failed to move past it on 4 occasions. There has been very strong selling pressure on the trendline resistance. So that provides a line of a key significance to watch. But on the downside, I think the October and November bottom is definitely in play. Likewise, if you look at Fibonacci confluence, I think the 10,800 also kind of marks this zone where the Fibonacci levels kind of coincide. So that also brings about the bottom in the small bottom in October, also the bottom in November, and now we are back at it again. The stance is, of course, if we were to break lower to a new lower low, it just means the overall downward trend will continue. But on the upside, I think the Nasdaq will really have to overcome this downward trendline resistance to sort of provide market sentiments with some uplifting for those technical traders, because otherwise I think the just looking at this chart itself, I think the overall trend still remains somewhat to the downside for now. Okay, last but not least, I think the volatility index is something that we can look out for. Generally, we look towards this 20 level. Why? Because generally the belief is that for any reading above 20, it kind of denotes a lingering market stress. So just using basic TA on the VIX chart, what I see is this index sort of being stuck in this symmetrical triangle pattern. So you can see from the black line itself, in terms of the index forming a lower high, but on the contrary also forming a higher low. So generally this pattern kind of denotes a market indecision. So I think we could sort of see a greater clarity once it is able to sort of break out of the symmetrical triangle. So somewhat of a moment of reckoning lying up ahead in terms of earnings season, in terms of course, the US CPI at the end of the week. So definitely a very interesting space that we can look out for. Okay, last will be the sector play. Why I'm holding back on the energy sector, even though there has been, some analysts remains very bullish on them. Just my own personal view, I think just looking at this chart, generally the energy counters tends to track oil prices very closely. I mean, the logic is clear. I mean, higher oil prices just means that they are able to enjoy a better profit margin, higher profits. But over the past few months, as you can see, oil prices have actually reverted lower due to recession fears, due to ongoing moderation in economic activities. And but on the other hand, the MSCI World Energy Index kind of pulling ahead. So why is this so? One of the explanation could be because corporate earnings can be lagging. So even though oil prices are sort of lower, I think on a year-on-year basis, many of these energy companies are still able to enjoy very stellar profits. If you can look online, I think the most interesting news headline recently is on how many of these oil companies actually deliver multiple months of bonuses to their employees. So you can just imagine the extent of profits that these energy companies are enjoying. And I think it does come with a lag in that, just because we will only get the results for, maybe fourth quarter in January itself. So it comes with a lag. So I think how I see this is that there could be a potential that, if oil prices continue to move to the downside on a further recession fears, generally these energy companies could start to sort of underperform. I know they are the top performer in 2022, but 2023, I think oil prices have moderated. So they may have to face a greater pressure in terms of delivering up to market expectations, because a lot of them are jumping in 2022 on this stellar profits narrative. So profits may remain strong, but growth may start to peak in 2023, in my view, just looking at the moderation in oil prices itself. So I think one of the theme is also on China. I think a lot of research houses are starting to turn bullish on China because of its reopening. I think I do stick with the consensus. I think the narrative for reopening has a very positive longer term impact. Some of the reason is because previously we've seen a policy measure in place, but economic conditions has not been very reactive. Mainly because there are still intermittent virus restrictions. Because if you were to cut lending rate, but consumers are still stuck at home, firms are still unable to operate as freely. The loan demand is still very muted. But with this reopening narrative, it does change the effectiveness of policy measures, in my view, which remains very supportive at current point in time. And next will be the recovery in economic conditions. I think with reopening, over the next few months, things may still remain jittery, but generally the worst is over could be in place, and that is where we could see a rebound in corporate earnings, and that will also provide another thesis to drive this upward re-rating in terms of their valuation. And last but not least, I think softer tone on regulatory risk, shift in focus to economic growth, and valuations still remain attractive both on a historical basis and of course against their global peers. So at least for the first quarter or maybe somewhat of April, May, I think things are still jittery, but it does, in my view, provide some chance to accumulate. I think some of the headlines may come in over the coming months to really drive some of the weak hands to offload their position. When there is this reopening optimism, I think everyone has been so eager to jump into a long position, namely because we know Chinese equities have a very, very, very bad year, and it does bring their valuation to really a multi-year low. So whenever there is this huge optimism, it does drive a lot of short covering. It does drive a lot of initial optimism that push this Hang Seng Index. If you just look at the Hang Seng Index, it rebounded 46% from November 2022. So there could be some, narrative coming in to really sort of drive out many of these short-term traders, many of these weaker hands. I think some of the headlines that we can look out for is presented as such. The less real risks, those risks that I think could be temporary. One is in terms of virus resurgences after Chinese New Year. If there's any headlines coming into play on that, market panic, I think the panic could be uncalled for, just because variants are vaccines are still resistant to variants, and looking at past historical instances, virus surge tends to be temporary. The next thing I think could come out with greater scale is the underperformance in economic data. So a lot of optimism on reopening, but we know that recovery will be more measured, namely because consumers will still be more wary in terms of spending, in terms of going out with all these virus waves. Firms will also be impacted. I mean, when you have a huge portion of your labor force being down with COVID-19, I think operations could be impacted. And that could lead somewhat of underperformance in the economic data versus what many, what markets are expecting. So there could be some form of a misalignment, and when a market realize that actually the recovery is not as optimistic in the near term as what many expect, I think it calls for somewhat of a retracement. But generally, we know that any retracement could still be a chance to accumulate, in that ultimately we are looking in over the longer term in terms of economic recovery and also in terms of corporate earnings recovery. So the other less real risk that I personally looking at is for those technical traders. So with that news of a reopening, we are seeing a very huge jump in Chinese indices or in the Hang Seng Index within a very, very short period of time. So this does change the picture of several several technical indicators. If you just look at the MACD, RSI, it suddenly reaches overextended levels. So I think looking forward, with many of these optimists jumping in already, upward momentum may start to slow. And with that, those looking at technical indicators may start to offload their position. If in the event, I think there's a chance that we could see some form of a display of a bearish divergence. Okay, the more real risk that I'm looking out for will of course be in terms of the build-up in pricing pressure. I think for now, CPI remains low. I mean, largely because consumer spending are still not recovering as much yet. So it does provide some room for easy policy to be in place without, overstimulating the economy. But looking forward, I think when a consumer starts to get out more often, this pent-up consumer demand could drive a build-up in pricing pressure. So if you were to see any move above 4%, I think many of the market will start to talk about whether China can maintain its commodity policies. So hopefully by then we could see an economic recovery, playing out to a large scale, but we never know, right? So we will have to be more data dependent on this. So the other more real risk that I think will be in terms of global recession risk. We know the two very strong arm in China economy is exports and also consumer consumption. So with reopening, it does help to provide some light towards consumer consumption, consumer demand. But the other economic arm is the exports, which is very dependent on the global economic conditions. And we know that generally when we talk about risk of a recession amplifying over the coming months, the demand for exports are really put into question. So one of the way we can do is to lean more towards those counters that are more exposed to China's internal conditions, such as catering, retail, entertainment, travel, as opposed to some of these firms such as manufacturing, which are more exposed to external risk in that sense. Okay, so just the last chart on the Hang Seng Index, ratio of Hang Seng Index versus the S&P 500. After recent rebound, I think it's still trending near its the 1975 levels. So multi-year low. So for those who do not want to really bet on a direction, you can do this sort of offsetting trade in terms of longing the Hang Seng and shorting the S&P 500, just to play on this convergence story into 2023. Okay, so likewise, I think technical break above 200-day moving average. There has been a very strong retest of that line in December, and it kind of marks a break. And I think, as I mentioned, 200-day moving average is largely looked upon to provide views of the longer term trend. So I think that kind of shift the trend towards the upward trend for now with this MA break. Okay, so next I'll move on to the Singapore teams. I'll just very quickly go through this one. If you look at the institutional fund flows for STI, has been relatively muted in December, but there have been some form of de-risking from these institutional players after the hawkish takeaway from the Fed meeting. So for now, I think funds are still very cautious on picking up the STI, at least in December itself. So I think some wait and see could be the preferred approach for now. And in terms of sector play, if you look at the breakdown from these institutional fund flows, financials has been picking up, but on the other hand, REITs have definitely been under a lot of selling pressure from these institutional investors. Okay, but moving into 2023, could the narrative change? I think possibly, whereby we could see some form of a renewed traction into the REITs sector. But several criteria will have to be in place. Number one, okay, later I'll go through the several factors that I personally am looking out for a REITs itself. But for now, just to really provide you with a overview of where things are in 2022, I think REITs underperform. Telcom, namely Singtel, has been seeing strong inflow, largely due to its defensive play. Singtel here, OCBC second in terms of net institutional inflow. Outflow wise will be Yang Zijiang Financial and also DBS. So DBS wise, I think just looking at this net institutional outflow for 2022, it can put many people off. But if we just backtrack a little bit, 2021, we actually seen very, very strong inflows from institutional investors that really more than offset this 237 million of outflow in 2022. So there are still somewhat of a more bullish positioning. But what we can see is that 2022, many of these institutional investors are starting to unwind their net long build-up in DBS itself. So something to look out for heading into 2023. Okay, back towards the REITs picture, I think some of the criteria when we look at REITs, of course, is the yield spread. So what is yield spread? It is the dividend yield of this, the forward dividend yield of this S-REIT against the Singapore 10-year government bond, which is largely looked upon as the risk-free rate. Because when you buy into REITs, you know, just looking at plain value, I know many of the REITs are delivering dividend yield of 6%, which are very attractive in absolute terms. But in terms of relative terms, you have to understand that the risk-free rate is also increasing. So we have the Singapore government bonds offering very attractive yields, so that risk premium, that difference in a premium that you are buying into REITs are really put into question. Because are you really is it really worth it to jump into REITs and take on that additional yield premium? But in exchange, you are bearing the economic risks that are lying ahead. So that's why many of us we can look towards the yield spread. So even though current S-REITs, the dividend is attractive on absolute terms, but on comparison with the risk-free rate, it's still below its 10-year average. So of course, if you were to revert back, I think it will be a very good opportunity to accumulate. Because when we are able to enjoy such strong yields and when the interest rate environment really starts to turn the corner and we are looking at the rate cut, I think generally the REITs could present a very good opportunity for a longer term hold. And Singapore REITs generally are more defensive in nature as compared to other countries' REITs. So you look at the US, many of these US REITs are undergoing a lot of a downward revision in terms of their property valuation. So their property prices are going down, but at least for Singapore's case, due to external foreign demand, due to our status as a very strong and safe capital city in terms of the finance city, I think we are still drawing in a lot of capital inflows that help to underpin many of these property valuation. So I think we are on at least for the S-REITs, we are on the more resilient space as compared to other countries in my view. Okay, valuation wise, looking at the green line, price to book, definitely at a multi-year low, far below is a 10-year moving average. So it does allow some room for a reversion back towards a more normalized level. But really, what I'll be looking out for is that if we are able to see a pause in the rate hikes, that really help to provide more clarity on the yield spread, and in a way that could help to provide some renewed traction back from institutional investors. So for now, 2022, these are the data for November. Still seeing outflow more than inflow from the institutional players, whereas on the other hand is I think the retails are accumulating more as compared to sales. So there's somewhat of a changing of hands. So something to observe whether we will see a trend shift here, whereby the institutional side starts to accumulate and the retail side starts to offload. I think that will be something that we can look out for, hopefully in the second half of the year. Okay, for a Singapore index technical analysis, likewise another consolidation pattern. So recently all the index has really been on this consolidation trend, right? So consolidation, one to watch will be whether it can break out. Yesterday there was an attempt to break, but within the first hour, if you observe the market, it kind of pulled back at a very quick scale. And if you look at the candlestick, is somewhat of a bearish pin bar. Today is somewhat a follow through. So it's really back to trade in this consolidation range. So really have to see how it can, move itself out of this rectangle pattern moving ahead. Okay, so with that, I think I've covered all of the main key themes that I'm looking at for 2023. Hopefully it helps to, provide some form of a value add to your own views, or maybe a differing views, something for you to ponder on. Yeah, so with that, if you have any questions, do feel free to type in the question box, and I will see, whether I can help to answer some of them. Yes.
Thank you, Jun Rong. Yep. So once again, just to reiterate, if you have any questions, right, just feel free to type into the question box. We have about 5 minutes, 5 to 10 minutes. We can think about that this timing to answer some questions. So before we go to the Q&A, right, the first thing is we have a question on the recording. So just wanted to highlight that today's session is a recorded webinar as well. We will be uploading it onto both the IG Academy and onto our YouTube channel. So if you are new to IG, right, today we are hosting it from the Singapore office. So just need to search for IG Singapore under the YouTube channel, right? And then you'll be able to look at some of the content that we already have, which is also our previous webinars. And of course, today's session, we also upload it there. All right, so we'll move on to the Q&A right now. And for the first question we have will be on the impact on dampening inflation. So I think one of the questions we have right now is it the interest rate hikes or the tapering that is providing more impact to dampen inflation? So what are your views, Jun Rong?
Yeah, so of course it's sort of a very sort of two-sided approach from the Fed, right? I mean, one is the interest rate, the other is the reversal of a quantitative easing, or rather somewhat of a quantitative tightening that is in play. But the main aim is really to bring down a demand to match a supply. So we know that coming out from COVID-19, there's supply disruption, supplies are low. And there's this COVID-19 boom, pent-up consumer demand is high. So there's this misalignment in terms of supply and demand that is helping to fuel many of these inflation. So you add that with, geopolitical tensions, lifting oil prices. So it's really trying to match demand to supply itself. So we know supply constraint has somewhat eased. Things are getting better there. So it's really trying to, match bring down demand in that sense. And if you look at recent indicators like the PMI figures from many of the manufacturing side of things, pricing pressures are moderating. But on the services side, I think there is somewhat of a resilience just based on the recent PMI figure. I mean, the pricing pressure are not moderating as much, even though the more outward-looking indicators such as new orders, all those are moderating to a greater scale. So it's really this balance that I feel has to come in to really bring down this inflation. And I think based on the Fed comments, I think they want to see a very consistent drop. They want to have confidence that inflation is on a downward trend. Currently, I think it's still too high. I think my best guess is that once it reaches around 4%, I think it really helps to provide a clearer picture that things could be under control, and that is where we could see somewhat of a shift in the tone from the Fed. And I think markets will catch that very well, because once there's a shift in tone, because if you look at dovish pivot, there are many different phases. I mean, the first phase is that the rate hikes come in at a lower scale. I mean, people look at it as the first layer of dovish pivot. Fair enough, that has already played out. The second one will be in terms of a rate pause, and then the third one will be in terms of a rate hike. So there are still two sort of wave of this rate hike process that markets can tap on for a rebound. So the moment I think that when they signal a rate pause, I think there will be a relief ready to tap on. The moment they cut rates, I believe there will be a relief ready to tap on. But generally, like I mentioned, when there's a rate cut, we could see one last wave of sell-off before we have this market bottom. Yeah, so hopefully this helps to answer your question in that sense. Yeah.
Okay, thanks.
Okay,
Yep. Yeah, let's look at some other questions. Maybe we can take a little more questions for another about 5 minutes or so. Yes, so another question is on the commentary that equity markets will be moving sideways. So any views on that, Jun Rong?
Yeah, I think very good question. I think markets moving sideways is a very, to me, I think it's a very general outlook. Personally, I think yes, we have to be more data dependent because even the central bankers are being data dependent. So we have to be reactive. That brings a lot of volatility for us to really tap on. But generally, I think it may not be somewhat of a sideways movement. I think over the longer term, it may be sideways, but breaking it down, we are still looking at trends, right? So at least for now, I think the trend is still to the downside. So the question is whether we can see a trend shift in the coming months, or hopefully in the second half of the year, for us to really tap on. So for those who are really more of a longer term investors, I think dollar cost averaging is the way to go. But otherwise, I think we can really look towards technicals. I think for now it's still a downward trend. So until we are able to see the sort of the worst is over in terms of economic conditions, in terms of corporate earnings, I think that will provide greater insights to whether we can see a shift in trend from there. Yeah.
Awesome. So another popular questions that the attendees also like to ask, we find that it's quite common, is on the sectors to look out for. So I think of the more popular sectors is EV, but are there any sectors in your view that's worth looking at?
Yeah. My view, of course, and many research house, I think, first half of the year, when we are still unclear on where economic conditions, how far it will moderate, a defensive stance is still the preferred way, right? So, like I showed just now, the value to growth proportion, I think, as long as when there is this talk about economic conditions trying to hold up, and also I think there could be some form of a continued play in value and growth. But moving into second half, I'm really looking at I want to see many of these big tech really moderate to a larger extent, such as like I mentioned Tesla, as I mentioned Apple. I think they are seen as the more resilient counters in 2022, just based on their whole year performance. I really want to see recession fears letting them cave into that, and that will provide many of these opportunities for us to really shift towards many of these growth counters itself. And of course, a rate pause should be in place to really aid to provide greater clarity on valuation. But other than that, I think some of the sectors, I think I saw the question here on EV. My view on EV is that for now, I think many of these Chinese EV are under pressure. I mean, Tesla has been cutting their price. Economic conditions are not recovering as fast. But I still believe in their longer term potential. I think once economic recovery picked up, there will be an improvement in mobility. And we know the Chinese government has been pushing for this green has been pushing these EV sectors, and once mobility starts to pick up when virus cases ease, I think the demand could start to come back. So that could help to provide some support for many of these EVs. And also when we look at EVs, one of the main thing is oil prices. So we know when oil prices trend lower, generally the EV are also coming under greater pressure, because I mean, if oil prices are cheap, there is lesser incentive for people to really turn to EV, right? So I think we have to see a base being formed in oil prices, because if it continue to trend lower, I think if oil prices starts to get cheaper and cheaper, the trade-off to really take on an EV is really not as great. So I think a base so two things. One is the base in oil prices, and second is the economic recovery in terms of Chinese demand. Yeah.
Okay, thanks, Jun Rong. I think we can take one last question on gold. So we have one question on gold prices. So the question is, what is your view on gold? There seems to be a lot of movement to the upside. Do you see a higher level, Jun Rong?
Yeah, so gold prices wise, previously there was if I recall correctly, previously year end there was a break below a very crucial support level. So but after that it actually turns out to be some of a false breakdown, and then things starts to came to the outside very strongly. So very hard to at that time, very hard to gauge the direction because everyone is bearish, and then there come this false breakout that really drive out or push out a lot of sellers in that sense. My view on gold is that once we are able, because the narrative now is about a rate pause, I think if with that, if we are able to see declining US dollar, declining US Treasury yields, these two will provide some form of tailwinds for gold prices in 2023. Previously, these two has been a headwind in terms of US dollar strength, in terms of higher Treasury yields, but the stance has been shifting towards, has been shifting in favor of gold prices. So I think it could continue to attract more buyers. But once we see a rate pause in that sense, the Fed will want to keep it, their stance is to keep it high for longer. So once we have all this optimism being priced into gold, when we see a sort of a peak, a pause in the rate hike process, once many of these buyers jump in, I think the next narrative will be in terms of growth risk. And even though gold has been a safe haven assets, but in times of a really economic downturn, in terms of a recession, it can cave in also. So I think for now, it's just to enjoy the ride until we are able to see a rate pause. But after that, once there is a market jitters over a potential recession, I think gold prices could cave in as well.
Okay, thanks for the sharing. We have exceeded the webinar by about 6 minutes. But before we end off today's session, right, I just wanted to highlight, if you are new to IG, the products and tickers that Jun Rong has shared previously, such as the Nasdaq 100 index, the S&P 500, the VIX, the dollar index, which is under this FX category. Everything is tradable on the IG, so including things like precious metals, energy products. So these are actually very popular products that retail traders are looking at. So if you want access to these products, right, they are always available for, we give you the access to this product to trade through the IG trading platform. And we also have questions on the YouTube channel. So just to provide a little more clarity, just go to youtube.com, be it your mobile or the mobile app or the desktop, the website. Just search for IG Singapore and go to our channel, IG Singapore. So just click on the subscribe button. We also upload today's session on our YouTube channel. So if you want to have access to our previous webinars or other content, just feel free to head over here as well. Okay, so with that, I want to thank everyone again for participating, and I'll just leave this feedback form over here. So if you can right now, please help us to scan this QR code to give some feedback on today's webinar session. Also, please share with us what you want to see in the future. So if there's any key topics, any products, be it, let's say, if you're interested in the EV sector, you're interested in Forex trading, you're more interested in commodities or, shares and things like that, just feel free to let us know in this feedback section. And then we will always take a look and see how we can bring content that you guys would like to see. Okay, so I'll leave this here for about 20 more seconds before we end off the session. So it's a very quick 10 question survey, if I'm not wrong. It takes about a minute to finish. It will help us to get a better idea on what content we can cater to you as well. Okay, so with that, I want to thank Jun Rong again for his wonderful presentation and sharing. Thanks a lot, Jun Rong.
Yep, thank you, Ethan. And thank you all of you for tuning in today, and Happy New Year to all.
Yes, and so I thank everyone as well for participating and asking a lot of questions in the Q&A. I hope the session has been of use and will be able to value add to you in terms of your own trading. So if not, then you can look out for this this webinar session again in our YouTube or IG Academy. And I'll end this off right now. So have a great night, everyone, and see you for the next one. Cheers. Bye bye.